All right. Hello, everyone, and thank you for joining us throughout the day here at the Lytham Partners Fall 2024 Investor Conference. My name is Robert Blum, Managing Partner of Lytham Partners. During this presentation, we welcome Bonterra Energy, ticker symbol of BNE on the TSX and BNEFF on the OTC. And joining us today, rather, from the company is the Chief Executive Officer, Pat Oliver, and the Senior Vice President of Business Development, Brad Curtis. Pat, Brad, welcome.
Thank you.
Thank you.
Perfect. Here, before we go ahead and get started and turn it over, I just want to remind everyone that management is available for one-on-one meetings throughout the day here at the conference. If you've not already reached out and coordinated your one-on-one meeting, you can send me an email. I'd be happy to get things coordinated. That's Blum, B-L-U-M, at lythampartners.com, or you can visit the landing page for the for the conference. That's lythampartners.com/fall 2024. From there, you can click on the investor registration tab and make your one-on-one selection. So with that, Pat, I'm going to turn it over to you. The floor is all yours.
Terrific. Thanks very much, Robert, and thanks to Lytham Partners for hosting the conference. We're excited to participate. This is Bonterra's first time at the conference, so yeah, we look forward to a good dialogue throughout the day here. So, first slide, we'd like to just a little bit about Bonterra. If you're not familiar with the story, Bonterra is a junior oil and gas company based in Calgary. We've been around for almost 25 years, so a very household name on the Calgary junior oil and gas landscape. Right now, I think the story looks very different from what it was even 2 years ago. We kind of cut our teeth in the business with the Cardium play. We have recently introduced 2 new emerging plays, kind of light oil trending plays called the Montney and Charlie Lake. So you're going to be hearing a little bit about that, later on in the presentation. So let me start by just Q2 seems like a long time ago, but just kind of a quick snapshot on where we're at. In Q2, we reported production of about 14,200. Of that, we had about 650 barrels a day shut in due to plant turnarounds. Funds flow for the quarter was about 31 million. We had net debt of 173 million, and we put up about 84 cents per share of funds flow. So most importantly, we reaffirmed our guidance for the full year in Q2. We now boast almost 450 drilling locations. The company is more sustainable than it ever has been in the company's history. So again, something to note that we've drilled 3 wells into these new emerging plays. 1 into the Montney, 2 into the Charlie Lake. Last week, those 3 wells were flowing 2,200 BOEs a day, or almost 14% of our corporate production. And just to put that into perspective and how that these new plays can move the dial, is that the other 14,500 barrels a day are coming from about 690 well bores. So again, we're pretty excited about these emerging plays that we've introduced and provide shareholders with a whole bunch of upside. Second slide is 2023 is long in the rearview mirror, but again, I think it's worth noting that the culture at Bonterra is that we are focused on meeting guidance. And 2023 was a great year for that. We were again around 14,200. We had our leverage down to 0.88 times. Operating costs were $16 a BOE, and capital spend was kind of in that 125 range. So Key deliverables and priorities for 2024, execution. So we like to think that we're best in class for, for our Cardium operations, and, and we see what our competitors are doing in, in this fairway. The key challenge for us now is to parlay that execution and excellence, into the two emerging plays, into the Montney and Charlie Lake. Financial discipline is key for us. There's a slide later on in terms of debt reduction, but we're going to focus on free funds flow in 2024, and again, just kind of prioritizing the balance sheet along with modest growth. I touched on the drilling locations. Again, the company is more sustainable now than it ever has been. We're about 450 what we call tier 1 drilling locations in the Cardium, Montney, and Charlie Lake. We will continue kind of our M&A quest. I would say M&A is going to be focused on our 3 core areas, but we would like to get bigger in the Cardium, and use M&A as a vehicle for growth and getting over that 20,000 BOEs a day range. 2024 guidance. Again, we put this out in last December, and I think I mentioned that in Q2 we're on course for meeting our guidance. Capital expenditures are going to be plus minus in the 100 million range. Production, which I think we're going to surpass, is in that 13.8 to 14.2. Today we're producing about 16,000 BOEs a day, and we're drilling a Montney well as we speak, as well as Charlie Lake drilling activity. So, free funds flow, this is pre-acquisition that we will talk to you about, is kind of in that 20 to 25. I would say that is, a fair target for 2025, as well as that free funds flow target. So next slide, stable production, modest growth. I think that's going to be the moniker for for at least 2025. You can see that on the bar graph on the left, the green portions are kind of the Charlie Lake. Again, one of the emerging plays that we're bringing forward. So you're going to see a shift of capital from the Cardium to the Montney and to the Charlie Lake, and that's really based on capital efficiencies. Like we're adding production in the Cardium at about 20 or 21,000 a flowing barrel. In the Montney, we're about 14,000 a flowing barrel, and in the Charlie Lake, we've got that down to 11 or 12,000 a flowing barrel. So we're going to be kind of harvesting, I guess, the cash flow from the Cardium, and and getting more active in the two emerging plays. And the bar graph on the right is just simply well count. So you can see that in 2023 we drilled 38 Cardiums, and you can see the transition starting to happen in 24 and beyond. Enhanced liquidity. I'm fairly proud of this graph, and you can see that there was a massive debt reduction, 21 to 2023. We reduced our debt on the balance sheet by $189 million, while at the same time, growing production by 34%. Now we had some help from commodity prices, but I think that's a tribute to the assets that we manage, as well as the folks that are doing the heavy lifting on that side. So a big, massive deleveraging project over the last 2 years. Currently, we're sitting just slightly under one times leverage. Return of capital. This is a question I get all the time. The company was was kind of one of the pioneers actually in the junior sector in oil and gas to initiate a dividend. We during COVID when WTI dipped down into the 30s, we eliminated the dividend. We are committed to getting back to a return of capital model, and that is both via NCIB as well as dividends. But the one thing that I want to have in place prior to doing that, is sustainability. And so I'd like to get the debt down a little bit, kind of into that 140 million range, or from a leverage multiple perspective, kind of in that 0.7 to 0.8 times. So, and you can see on the bar graph on the far right, the earliest that we would put a dividend or reinstate the dividend, would be Q1, where you can see we're 0.8 times and about 133 million of forecast net debt. So with that, I'll turn it over to Brad, who will take us through our three core areas, being Cardium, Charlie Lake, and Montney.
Thanks, Pat. The Pembina Cardium is one of Canada's largest conventional oil fields. It was actually discovered back in the 1950s, and early 2000s or mid 2000s, we started multi-frac horizontal well development in this play. And it started out with expanding the edges of the pool, and has since kind of grown into increasing recoveries within the pool by drilling horizontal wells. Since 2008, Bonterra has drilled about over 400 horizontal wells into this pool. Again, because of its age and the number of wellbores that penetrate the field, we have a wealth of engineering and geological data on this. So we have a very good understanding of what we're going to get on a section by section and a well by well basis. So essentially what we're doing with this asset is building widgets. We know what we're going to get on a well by well basis, and it's low risk funds flow generator for the company. We operate 92% of the field, so egress and oil infrastructure is handled well, and we have 294 locations booked ahead of us. So again, just a cash flow generator, which we use to develop the other two plays, the Montney and the Charlie Lake. Over the last, I'd say 5 years, we've been on a quest to improve our corporate inventory. And the two plays that we identified right away were the Charlie Lake and the Montney. And since about 2021, we put together a 37-section block in the Charlie Lake through land sales. And earlier this year, we closed a transaction for about 23 million to add 79 net sections to that land holding. So totaling about 116 sections. On that 116 sections, we've identified 115 Charlie Lake locations, and we like the Charlie Lake a lot because of the high IRRs, about 110 to 160%, and less than 1 year payouts on these wells. So they're high impact wells. And again, we've identified 115 of those locations. This year, we've drilled 4 wells. 2 of those are already on production, and they're exceeding our type curve right now. So we're very excited about this play, and it just allows us to really ramp up the free fund flow generation of the company. Our plan here is to get this asset up to about 6,000 BOEs a day and kind of hold flat at about 6 wells a year. So we're expecting this asset to generate $50 to $60 million of net operating income annually once we get to that point. This kind of just gives an idea of the development plan that we're expecting, a growth up to about 6,000. And you can see that this asset becomes self-funding in early 2026. So again, it just creates more free funds flow that we can use to develop the Montney or to initiate returns for investors. Similarly, the Montney play in 2021, we saw an opportunity to acquire land via land sale, and we put together a 50 section block of land for less than $3 million, so very low entry costs. We really like this play. It's very similar to Permian. It's a shale-based play, and we drilled our first well last year in Q3, completed in Q4, and we just turned it on this year in 2024. And again, our well here is exceeding our type curves. We are currently drilling our second well to the north off that same pad to delineate the land. So we really like this asset. We have about 95 locations identified, with more possibly to come in different benches along the Montney. This play is very attractive in the Western Canadian Sedimentary Basin, and I'm sure you've probably heard of the many operators attacking this play and having great results. This just gives an idea of where we're drilling in the Montney, in the D3. Drilling cost about 3.5 million, and completion cost about 4.2. We expect to be able to drive those down as we work through this play and develop it. This slide really does a good job of explaining why we've moved capital from the Cardium into the Charlie Lake. And again, as Pat mentioned, it's all about capital efficiencies. And you can see that the Charlie Lake, between 11 and 12,000 of flowing BOE in terms of capital efficiencies versus the Cardium at 20. So we expect to be able to spend less money and get more BOEs out of the ground. What we like about the Montney is the massive reserve upside that it gives the company. For every Montney well, right now we're booking about 600,000 BOEs on a 1P and 800,000 MBOE on a 2P basis. So very large reserves on a per well basis. And we expect that, as we drill the Charlie Lake and have less than 1 year payouts, that capital will be able to fund the longer tenor Montney. Do you have anything to add to that? Oh, you're muted. Oh, you're muted, Pat. Okay.
Yeah, what I would add is that, I think the company is really at an inflection point where we've got this beautiful made for junior oil and gas play in the Cardium, which provides that stable, predictable production and cash flow. And we're just at very early stages, with the development of the Montney and Charlie Lake, which have the ability to move the dial, significantly. And kind of you can see with the IP 365s that it's a very marked difference in terms of the three plays. So really excited, kind of how the company is positioned moving forward.
Yeah, and I should mention, when we look at our reserves in 2023 year-end reserves, we actually only have 3 Montney wells booked in these numbers and no Charlie Lake. So, these reserves that we're looking at right now are predominantly our Cardium. And what I like to point out on this slide is that 80% of our reserves are proved. Again, a testament to the fact that the Cardium is a known entity, and our reserve evaluators, as well as us, have a really good understanding of what we're going to get on a well by well basis. When you take those reserves, and we think they're pretty solid, and throw it into a NAV calculation, which has our debt and our full abandonment reclamation built in, what you see pretty quickly is that there is a value proposition just on our PDP reserves. At $70 oil and $2.50 GJ gas, that's Canadian. That's WTI is US. Our NAV is about 772. So we have a very strong base of value in just our base assets. And then when you layer on the Charlie Lake and Montney that we're just getting off the ground, I think there is a value proposition here and built into Bonterra.
Yeah, and I would add that, I would describe the market right now as being a very show me market, and I think that's absolutely fair. The 3 wells that we've drilled so far in the Montney and Charlie Lake we're super pleased with and above type curve. So, again, if we continue along that trajectory, I think we're going to start to get credit for these 2 new plays. As Brad alluded to, we're trading at probably 60 or 70% of our PDP in the Cardium. There are no reserve bookings at all for the Montney and Charlie Lake. So that is all kind of upside to our shareholder base. So that's kind of, I guess the other thing I'd like to add just on the corporate information strong leadership team, we just press released a couple of weeks ago the retirement of our CFO, Rob Thompson. He was with us for almost 12 years, super strong CFO, and it's going to be sad to see him leave. We have hired his replacement, Scott Johnson, who is now working in tandem with Rob. Scott is a former partner with Peters & Co, so brings a strategic element to our team as well as a strong capital markets element as well. So I think that's worth mentioning. Yeah, and I think that concludes our presentation. And I'm not sure, Robert, if you have any follow-up questions. Or...
Yeah, we got just a couple of minutes here, but I guess when you think about maybe the biggest misunderstanding of this company from where you guys sit versus maybe an outside perspective, and you sort of acknowledge some of the fair show me status, but what do you think that sort of misunderstanding might be in the markets right now?
Yeah, that's a great question, and I think it's just getting the story out. Like I'm 2 years in the CEO seat, and so like I'm trying to kind of get in touch with our shareholder base and tell the story. But I think Bonterra is still viewed largely as this sleepy, steady as she goes Cardium producer. I think the task at hand now is to tell the story, and that we do have these high impact plays in our portfolio that we are not only developing, but we're aggressively drilling these 2 plays. So I think by the end of 2025, this company is going to look a lot different than it is right now.
Yeah, maybe just from a hedging perspective, what sort of strategies are in place? Anything investors should be sort of mindful of?
Yeah, it's kind of a fine balance, the whole hedging discussion. To me, it's hinged on business reasons for hedging. We do have an amount of debt on the balance sheet. We have a capital program that we need to finance each year. As well as that return of capital model that we want to get back to. So those 3 business reasons, I think precipitate a hedging program. We've chosen 30%, so we are hedged out for at a level of 30%. That's both liquids and natural gas for the first 9 months or for the next 9 months. So we think that's a comfortable level of running our business, and I think that will continue, and that provides shareholders with still ample exposure to the commodity, while giving us some comfort to address those 3 business reasons I alluded to.
All right, perfect. Well, look, I think we're sort of getting close to the end of the time here. Any sort of maybe final wrap-up comments that you might have?
Yeah, no, thanks, Robert. Again, I would just reiterate that really like the way the company is positioned now. I think we've got 15 plus years of of drilling inventory in front of us. We are sustainable, and we're 50%, 57% weighted to light oil, which I think is important from a cash flow and netback perspective. So, I think when I look at our competitive landscape, I think we stack up fairly well.
Fantastic. All right. Well, Pat, Brad, thank you very much for your participation in the conference here today. We hope you enjoyed. I know you've got a busy schedule of one-on-one meetings here. I will remind everyone, however, that if you've not already coordinated your one-on-one meeting here today and would like to do so, send me an email. Again, Blum, BLUM at lythampartners.com. Visit the website, lythampartners.com/fall 2024. Again, from there, you can click on that investor registration button. And I'll sort of make this comment as well. If we can't sort of make it happen today on October 1st, reach out and look to get something coordinated afterwards as well. So again, Pat, Brad, thank you very much for the participation. Hope you both enjoy the event.
Thank you.
Thank you.